Okay. So first of all, welcome. Thanks everyone for joining. I will just introduce something about GitPro. I know some of you might have heard about GitPro, some of you have not. It's been a while that we had any such events. We used to have many such events in a much bigger scale in the past. So this is like we are restarting this, and thanks to Amey for pushing us to restart this. So GitPro, just to give you background for everybody, it's an organization mainly for the technology folks. It's a non-profit organization started in Silicon Valley. And the goal of this organization is to have kind of a social network with all the technology professionals across the US. There are multiple chapters in the US. So the biggest one is in California, which is I will. So, as I said, there are multiple chapters. The biggest chapter is in California, and the second biggest happens to be in DC. And the goal, as I said, is for all technology professionals to network. Primarily because these days, with all the jobs, everything that is going on in the technology world, the more we network with all common-minded people, such as Indians, and it's mainly for Indians, the better it is for both for job opportunities, for influencing any policy making, such as green cards, H-1Bs, or any policies that will impact technology professionals. And the other thing is, apart from social networking, the main biggest thing that today you're going to do is learning, right? Learn from an expert, learn from people who have been there, done that. Learn something new, not just related to investment, not just about making money, but also about, so in future we will have sessions which are more focused on, say, how do you do generative AI, for example, right? Or how would you create a new business? So if you have an idea, how would you go about creating a company? Like we'll have sessions around those kind of things. So the goal is to, again, as I said, network, to give back again, so that we can learn from here and give it back, like how our is doing. To have learning, more and more learning, and also to just have fun, right? So with that, I wanted to introduce the session for today, and it's very interesting, and you see the interest here, right? There is, because anything related to investment is something that triggers a lot of interest. So I was talking to Amey a few months ago, where he said that he built a very cool investment app that will give you insights into how you can invest into options trading, right? And that's an app he built based on a lot of his own personal research. You will see the amount of research he has done in terms of building that app. And he has used that app in the past, in the case in the last 1-2 years, to make money. Everybody wants to make money. So he made a lot of money. And he is kind enough for sharing all those details with us. So for the next 1.5 hours, there will be a background of what the app is all about, what's some of the background of options, how to go about trading options. He will deep dive into the app itself. Of course, if you have questions, you can ask it immediately, or you can hold it up to the end. And he also promised towards the end of the session, he will give you all access to his app. It is completely hosted locally at his home. So of course, when everybody wants to access it, might slow. So be cautious about that, but he will give access towards the end of the presentation. Okay. Any questions before we begin?
Good.
All right.
Okay. What Ashwinji said is correct, actually. I was previously on these GitPro programs. Some of the programs I will never forget about it. And this is my dues to basically provide what I can share for my GitPro program. As a give back.
Thank you for giving back.
And now we can continue. Now, most of the things, what happened here now?
Yeah.
It came? Okay, good. Why this one is? Okay, now. Right, yeah, okay. So what we are going to do today is we are going to do a quick demo first thing in 1 or 2 minutes, quick demo of the app so that you can see whether the value is there or not. Then we can see a brief history of developing this app. If we just say that, hey, this is what I done, there is no point of why you done this. That's the question we want to understand. If you buy into that logic, then it makes sense to basically says that, okay, now this is the way we can improve ourselves, or we can think about in this way. That's basically, that is the required to understand a brief history behind this app. Then we can go over the technical details, like what was the modeling we done and why we done this modeling will get discussed today's presentation, and mainly the math behind the modeling. We are going to talk about it. Then next thing is we are going to review the detail level app. We'll go slowly. We can go her app by app, page by page, how to use that page. Then the most important, this is the most important question, how to use this app. Now, just providing the information is not helpful for anybody. It has to be useful to other person. And if you are saying that how to useful, then can you show me, Amey, that how you use yourself? That's the question. Like anybody can come and say that I will make the option trade like this. But did you use that? Then I will show my some live trades and some my recent trade. Recent is basically, let's say, April month. April month trade we can see, and we can understand why we done the decision at this moment, at that time. Okay, and the Q&A is open. Ask the questions right away. Don't hold back your questions, because we don't know what context at that time we are going to talk about it. Okay, so no, we'll go back. Actually, we'll talk about a brief history. No, we are going to show the demo first. Okay, so here is the what you are showing there, and what it's showing here is different.
Just come out of the presentation.
Okay, now come out of escape. Okay, let's go ahead and do this. No, it's not going out.
Share the PowerPoint. Yeah. Go back to the PowerPoint.
Go back to the PowerPoint. Okay. No. We want this website.
Go back. Now you go to that.
Okay. So this is the app actually. When we click here, it goes to the second derivatives hub stock login. Okay. I have Amey Dhore and some password. So let's log in actually. Now the first page is going to show the market information. What do you mean market? Market is nothing but S&P, then the NASDAQ, then the Russell, then basically the Apple, Microsoft, NVIDIA, Meta, and all those things. What about these diagrams? We will come back. Next thing is that if you want to play earning play, these are the symbols. If you want to get to the strangles, these are the symbols. If you want a detail about anything, we can click on that and we'll get this information. We go to the strangle, then the straddle, then we'll come back to the zero DT. Zero DT is nothing but the day trading. We'll come back shortly. The butterfly trades, the pinning, if there is anything pinning, we can get the pinning data. Then what is the option trading we can do for the basically a calendar. Then we have to get it down a little bit, this guy. Okay. Yeah. Okay, here. Then long and short, where we can play a long and short, what is a positive gates, negative gates, and a lot of people do the investment. What stocks are good for the investment, and each has a score which shows that which is the like a right information for doing the investment, and how this quick ratio or the current ratio or return on equity and all these things. By using all these things, the score is get calculated. This is basically the overall app. If we go over the day trading, we can come here. Now the previous information which I show is get populated every day at 10 o'clock. Everything is automated, by the way. But the day trading information get populated every 15 minutes. So if you go ahead and take a look, here is the data at, by the way, market is closed May 3rd at 5:35 is the last data I have, which is basically, this is where the market is basically closed. But every 15 minutes, you can see the data get populated and it get pushed here. That's the way the application is done. And we can go back to the return to the main application. And here is the application. Now, we'll go over all these things. It will take 1.5 hours as we discuss. But before that, we'll talk about a brief history. The question is why we developed this app at the first place. That is the most important right now, the question. Because just showing you something, some data point on the chart, anybody can come and show it, right? The question is why you develop this app or what is the necessity? So let's understand that necessity. So like when the COVID gets started, we are all start working from home. So I start doing a swing trading. Swing trading is nothing but buy right now, sell at higher price in maybe a month or a 15 days or a day or a 2 months, something like that. Or the price is high, sell at high and wait for the goes down. And that is the swing trading. Everybody does that. I done for 1 year. Yeah, I make it around $8,000, $9,000. But what I notice at the end of the year is I make $13,000 and lost $7,000 or $5,000, something like that. I was not happy internally. Okay. Making like, it's very, very difficult to say IBM is going 10 points ahead. 10 points means $10 up next week. It's very difficult, very difficult. Then what? I was keep thinking, then I saw there may be option, the derivative market. Now the equity market is a 50 trillion market. But derivative market is a way bigger than the equity market. My gut feeling says that derivative market, we should give me the direction. The delta, which is basically how much stock is in and out or how much stock has a value or how much probability the stock will go inside the money, that should give me the logic to build, to give me the clue. I spent 8 to 9 months by developing the complex logics actually as such. And I put a weekly, I say, this is my weight for the in the money, out of money, call, put weight, call some weight, put some weight on different values I put. Nothing is working. Not, at the end of the day, I have those scripts right now here on my Thinkorswim platform, but nothing is working actually. Got frustrated. I was thinking myself, we are engineers. Stock market is nothing but our art and science. That's the way they call it. Stock market is nothing but, like a trading is nothing but a science come art. I'm not an art person. I'm a science person. Engineering is nothing but applied science. How we are going to solve this problem? It's something we need, that we need something to solve this problem. But delta, who is a main derivative, the first derivative, is not helping me out. By thinking all these things, now I say that, okay, if the delta is not helping me out, who is controlling my delta? If king is not helping, let's go to the kingmaker. That's the thought process come to my mind. Okay, I said, I come to the gamma. Delta is basically controlled by the gamma. Gamma says that how fast the delta is going to move. Now, gamma is there. But what I'm going to do with that gamma value? It's 0.03, 0.02. What? I'm not getting any clue out of it. Then what I preach my kids is math is the mother of all science. Now, if the option market or the trading is the science, if everybody says that is a science, then math should solve this problem. I say, okay, let's try with the math. And I start reading a lot of books as such. While reading all these books, I come up with the various thought processes, logic and everything, which we can talk about the technical detail with some like quick review on some technical detail and math behind the model that we can talk now actually. But that is the premise why I move from swing trading to looking at the deltas. When the deltas options are not giving me the direction, I come to the second derivative. And that's the reason I put the name of my app is a second derivatives hub. That's the name of my application I developed. So we can take a look now actually as such. Go ahead, sir.
When you were doing this swing trading, did you try signals trading, like day trading with signals, or like you were like just putting long calls?
Okay. When I was doing a first thing, that is day trading is a different thing. We are talking about a swing trading, right?
Yeah.
When we are doing a swing trading, when I started that career, at that time, I was basically buying a shares and all this shorting the shares. That's basically a pure thing at that time I was doing. I was not going over the call or the put. Another thing is that with the call and the put, when the positive theta or the theta is the negative, which is the time value you are decreasing it. If I say today, hey, Tesla is now 180, it will go to 200 at the end of the month. If it not goes, I lost all $10. $10 meaning $1,000 I lost as such. That is not a good way of trading as such. And I will show you the different things as such. Any other question?
Just if you can take 2 minutes to explain the options, overview.
Overview. Yeah, we'll get into those as such, right? Okay, I have the detail, but let me quickly explain what he asked instead of going over that. In option, there are two things. One is a call option and one is the put option. Call option is nothing but if the share is Apple share is $100. If you speculate it will go 110, then what you will do, you will buy the call option at 100 and expecting to go at 110 and sell the call option again. So you buy and then sell. Same share, Apple. If you think that it was $100 and you think that it will go to the 80, you will buy the put. Once it goes down to the 80 or 90, doesn't matter, it has to go to the 90. 90, you will earn money, you will make money. Now, in this, we have to understand when we talk about options are a really good way to make money, but we have to use a right way. What I told you at the first time is that IBM, that was the example we talk about, IBM going to the 10 points up in the next week, saying is impossible or not, it's difficult. IBM will go up or down, meaning it is a one directional. X-axis, y-axis, one up or down, there is nothing. But when we talk about the option, you make money multiple ways. You make money by the delta, which is up or down way. You make a money by time value, theta, and you make a money by the vega, which is nothing but implied volatility. And that's the reason stocks make money only by using the delta, which is a one directional, unidirectional, up or down. There is nothing in between. In option, you make money by three ways: delta, which is a directional move, theta, time move, and vega, which is the implied volatility move, which is nothing but implied volatility is increase or decrease. Make sense till now? Now, when you make a money, you will lose the money on the three ways also. Just don't think about positive way. Okay, stock will go up. If you 100, it will go 102. You will sell 102. You buy call option. Even it goes 102 after 2 months, but your stock is option is expired after 1 month. You lost money. Do you see the difference? And that's the reason stock is for investors. And options are basically for the speculations purpose, speculators. Make sense? And that is what we are going to exploit it today. At the end of the session, we are going to see how we are going to make a money out of all the knowledge what we are going to talk today. That is the end goal. Okay? Yeah. So we can. Why this has happened like this? Okay, good. Yeah, some delay is there. Okay. So first thing is that we can talk about a dark pool. Now, we can read all these things, but mainly what is a dark pool? Dark pool trading refers to the private off-exchange trading of financial instrument. Like let's say Ashwinji has a 401k of Apple 10 million shares. He cannot go to over the market and the Nasdaq and say, I want to sell 10 million shares. He will bring the market down actually altogether, right? And another thing is that, let's say Apple share is $200, or initially in our discussion it was $100, right? To keep the $100. Wherever he comes with the order of $10 million share, that Apple share will come down to 80. So he will not get $100 out of that. So what he does is he talks to this guy, another person, okay, off exchange, and says that, hey, I have a $10 million. Today's market price is $100. I will sell you for $100. Do you want to buy? Negotiation happen. Let's say 99.5, he buy it. He sold it. This information was hidden from here. Now, 35%, I'm saying quoting less, but in this modern days nowadays, lately, like late 2010 and all those things afterwards, this trading is happening more and more and more and more. And that is the reason, literally what is happening in the stock market on a share, what that trade is going to impact, and which we are unaware of that. Everything we saw only what is happening on all the stock exchange, but this area is totally unaware to us, and 35 to 40% of the trading happen on this area. And that is, we need to understand that, yes, not only our over-the-counter trading is not going to support, but this is also going to impact us, which we have to understand.
This is like the dark net.
Dark, yeah.
So, Amey,
Hmm.
so none of the volume that you see is going to show up.
It shows us afterwards that trading is happen. They done trading today. Maybe that volume comes after 10 days or 5 days. I don't know when that volume get reflected to the main exchange, when they registered and all those things. But that volume is, we don't know what happened that time, and all of a sudden the price will change of the stock because they already traded that much, right? So that get impacted. Now, this is just for the information, but like stock purchase option trading. What it says that investment type, ownership of the company. Stock is nothing but a ownership of the company. Options are basically just the, like, I'm just saying, say buying and selling. It's not like any ownership I'm getting from the company.
Insurance premium.
Yeah, that's the way. That's it. The cost, share of the cost, premium per plus commission, which is very, very less actually. Like if you want to buy like a Apple share, it is $100 in our examples. But if you want to buy a call option, it will hardly $5. You see the difference, how much for buying 100 shares of $100 is a $10,000, but here you are just investing $500. That's the leverage you get. Now it says that premium plus commission, that commission you can ignore right now as such. Okay, that commission is, we talk about 65 cents or 25 cents or $1. That's a commission, we can ignore that. That's not a, the risk, potential loss of limited to the share price. Like let's say $100 share goes to $90. You lost $10 each share, 100 shares in our example, we can lost 100 multiplied by 10, $1,000 you lost. Against if you lose, if you buy a call option and if you lose part of that money. Reward, limited stock. I will not go over all the details here, but those are the stock versus the option difference as such. This is the important slide we have to really pay attention and understand. Now, in this example, let's say every trade involves the market maker on the other end. Let's understand that concept first. Okay, let's use we want to buy a home. What happened? Other party is selling the home, I am buying the home, and the agent is facilitating our communication. That's all. There is a seller, there is a buyer. But right now, I want to buy Apple at 170 call. But other side, nobody is there actually to buy that call at that instance. That's the reason they are the market makers. They are the agents. Think about it. In home market, the agent is nothing but market maker in the stock market. What is their role is provide every morning, they provide bid and ask. Like I want to sell at this price, I want to buy at this price. Clear, they does that every day. What they get they get incentive out of that. If they provide that, the exchanges, there are a lot of exchanges, New York Exchange, CBOE, ICX, there are a lot of exchanges are there. So they will give them the incentive. Okay, and then they make a money by buying at ask price and selling at the bid price. That's basically like they make a money. Okay. Now, when the trader buy the call option of 0.5 delta, Apple, we buy a 0.5 delta call. They're speculating that the underlying asset price will rise. We've done all the technical analysis. We write the moving average, we wrote MACD, RSI indicator, everybody come up with some other indicator and they use that all this logic. And we say that this Apple will go up and I will make money. Other side is a market maker who is buying that, who is selling that call option. What is incentive for him? He is like a losing business. Who wants to do this business where the one person wants to do all the analysis and says that this stock is going up, and other person simply saying that, okay. Think about the put side. I have $1 billion portfolio. I'm buying a put. Other person selling the put, meaning if the stock market goes down, I will get benefited. You are losing. Who is going to do the business like that? But somebody has to do that business to start this stock exchange every day, every second. To do that, what does that stock market, the market maker does, is sell this call option. The buyer is buy that call option for 0.5 delta. Now the seller, the market maker, go ahead and sell that option to him. And right away, go ahead and hedge that position. Now let's say hedging is what actually? Now, when you buy a call option of 0.5 delta in our example, okay, 0.5 delta, meaning you are long 50 shares of Apple. Okay. The market maker is a short of 50 shares of Apple, correct? What he's going to do is he's going to buy the 50 shares directly. Meaning what? For a certain amount of time, they are, whether the market goes up or down, doesn't matter, because one way he lose the delta, one way he gain the delta. Whether market goes up or down, they don't care. Agree? How the market makers are working in the market. Okay. If the price of the underlying asset, and last few sentences are the same thing what I'm going to repeat, but we'll keep attention here. If the price of the underlying assets start to rise, the market maker who short these calls begin to lose the money, as we discussed. To offset or reduce these losses, market maker can start buying the shares of underlying asset. Correct? Market maker buy a millions of shares in this scenario. They are very big people. Like, think about it. You are a 401k person. You said that I'm buying 1,000 shares of Apple, like call. He come up with a different. They don't care about the dumb money. We are all dumb money actually. All the small people like us are the dumb money. Who is the big people? The banks. Our retirement fund, where everybody is paying every month. They have a biggest asset. They go on the market and buy. And by the way, option market never goes into dark pool. They cannot do this trading outside. This is only happen in the exchange traded side. So everything is visible to us. Next thing, this strategy helped to offset the losses from the short call with the profit from the long share to achieve the delta neutrality. This is what exactly we talked in a few minutes back, right? Whether he is less 50 or losing the money on the call side or getting the money on the deltas long share side, it's balancing out each other. Are you following it what I'm saying? Okay, good. Now, market maker profit is from bid and ask spread. We discussed already about that. There is a difference, so they get that bid. This is not that simple. We'll dig down. That's the last line is useless. Okay. Now, the world, when I say world, is nothing but 401k, retirement account, investment banks are long. What is mean by long? You all are putting the money in 401k. They have billions of dollars. Now think about in this way for 1 second. You are responsible. Abhijit is responsible for $1 trillion. He can sleep? No. So what he has to do, he has to insure some way. We have like a $500,000 home. We have to insure that. We have a car for 50k. We insure that. Now we are talking about $1 billion and $1 trillion. What they want, they have to insure that. Correct? Because think about in this way. Any company says that you put the money there and that money drops drastically. Are you going to use that company for any future reference? Nobody, everybody will come out of that company right away. So they need to protect their money. Okay. To hedge their long stop option position, they generally buy the put, and to sell their costs, the cost, they sell the calls. Now let's understand this line. Now, when you buy the put, I was explaining to this. When you buy the put, what happened? You have to pay the premium to get that protection. Insurance is nothing but we are giving money to the company saying that if something happened to my home, come and fix me up. That's the reason I'm paying $1,000 right now to you. Correct? Same thing here. But think about in this way that if he has $1 trillion and if we keep buying the puts and market keep on going up, what happened to his portfolio? He's losing the money every day. Now, in that case, are you going to invest that person? The answer is no. Because if your money is going down only, what is the use? Because of that, to make that money, he go ahead and sell the call option. Now, what is the sell the call option? Let's say our Apple share is at $100. Okay. Now, I I buy the put if it goes to 80. Below 80, I want to get protection because there will be a leeway of here and there, a small thing, right? That is absorbable. But if it goes directly down 80 below, then I want to protection. But if it goes to 120, I want to sell that stock because I bought it $100, right? It goes to 120, I will sell it. But when you sell, you get a premium. So they balance that premium. That's it. Make sense till now? And slowly, they increase the portfolio. Now,
I have a question. So you are saying that the market makers are mostly long. That's what they also expect. That's why you're saying that they buy the port and they sell
Okay,
the.
I think opposite way. What I say world. World is not market makers. World is nothing but, think about we all. To protect us, we go ahead and buy the put. We are long means what? We have some shares, some equity.
So the world is us.
Us.
Ah,
Us means
That's
we are not talking about small people like retail people. We are talking about the 401k asset owners, big people, retirement fund people, Vanguard person, Fidelity person. They are the big people, right?
institutional.
Institutions. Okay, so they are the long. They go ahead and buy the put and sell the call. Hence, this line is important. Market makers are majorly short the put and long the call. Are we crystal clear till now? Now, this is 100% correct? Answer is no. No, even I wrote down the software, I can say that this line is not 100% correct. But after doing a lot of analysis, what I found out is that even this line is 98% correct. I am okay. I don't need 100% in this mark. Makes sense? There may be some institute where selling the call or the buying the call. I'm not there. They may be changing their positions, but they are very low. Most of the people logically thinking they're going to buy the put. Some of them, they may be selling the put. No doubt. Even this is like, that's the reason I'm saying that this line is not 100% correct. Even it is 80% correct. I'm okay with that. That is my assumption. Okay. Now, there are 3 algorithms right now. Whether we really, the market maker is a long, buy the call or short the call. There are 3 different algorithms are there. You can do the every transaction and check what exactly happened. If it is happened in the mid price, you can see the previous transaction, what happened. It's a really beautiful algorithm. You require a lot of computing power. And I don't have that. And another thing is that buying the data to do all these things is too much for me, actually. I cannot do that. So I go with the assumption that this is the line is true. May not be 100%. I'm not quoting it saying that. May not be 100%. But that line is what I go ahead with that. These I think I wrote down that only, right? Or commission. Okay. So there are multiple algorithms for developing the check if market to buyer is okay. But the end of when we calculate the gamma. Okay, we'll talk about this one now. Now, what happened is that now today they are balanced. Okay, but what happened tomorrow? Today they buy 100. Apple was 100. They delta hedge properly, and they are gone very happy at home today. But tomorrow the Apple is not going to stay at 100. That will be 105. Now what happened? They are already on the option position where they are making a loss. What is happened that they need to dynamically hedge. that position. And that dynamic hedging is what I am using. Is it make sense till now? That I'm not, who is my friend? Market makers are my friend. I am looking at what the market makers are doing day-to-day basis because of the underlying is changing. That is, and how they are hedging. I'm using that hedging to figure out what is your gamma exposure, Vanna exposure, charm exposure, all those things we can talk in the future, right, in this call presentation. But that is what the application is built on. Are we crystal clear on this? Because this is a very, very important, the basic fundamental, how we develop this application.
Can you give an example? You said like, $100 Apple.
Okay.
And you don't want to lose money.
Okay.
A lot of money. So you say that like I'm buying in put calls for $80. So like.
Yeah, I mean, let me go over with the same example. Apple is at $100. Now, I have he has a 10 million shares of Apple. What he wants to protect those shares. So what he does, he buy a put, meaning saying that if it goes down, I want insurance. You buy it from me. Now, generally what he does is that in the market, plus minus everywhere, every day happen. They knows these deltas. So he said that if the market goes below $80, it goes to 20, then I want you to buy at $80. That says then he buy the put. Market maker go ahead and sold that put. Okay, that's the one scenario. But to make the $80, when he buy the put for $80, he must be spent $5 or $2, something like that he's spending because he's paying the money. It's insurance. So what he does, he go to the 110 strike. Or in our example, we talk about 120 strike. 120 strike and sell the call. Sell the call is nothing but we are saying that if at the expiry time, if the Apple share more than 120, if 124 also, I will sell it at 120. In this case, what happened? He said, I have a $20 profit. Simple. He is happy.
He's earning the premium.
Yeah. No. Premium is different. He is getting the delta, which is nothing but $100 changed to 120, but actual price to 124. He cannot sell at 124, but he is selling at 120.
The market.
Why? Why he is doing that? Because he buy the put, he give the money to the market maker, he's selling the call to get the money from the market maker. So that at the end, if nothing happen, he's not in a big loss or big gain. Clear? That is the point actually as such. Okay. Any question?
So the market maker is getting money from the put of like the commission you paid on the put. He's making money from that.
Yeah.
Plus whatever upside it is.
Yes.
Market makers are making money, right? They are going to get commission on the put, they're going to get commissions on the sell.
Sale. Yeah.
Sell everywhere.
Everywhere they can get a commission, and their business is nothing but difference between the bid and ask price. And to do that market neutrality, they go and buy and share the buy or sell the shares, underlying shares. Think about not stop here. Think about the next day. Their deal is already done, but market maker stuck with next 1 month, 2 months, 6 months, whatever he buy the call. He's not going to get a other person the same call to sell. If he get, he will sell it and he make money, no problem. But most of the time he will not able to get that sale. So what he does, the next day, he again hedge it based on the position. And because of that, if you see that when the market open, that first 15 minutes or first 5 to 10 seconds, even or 1 minute, big volatility happen. Volatility is very high. And end of the day, volatility is very high. Because the market makers are basically hedging their positions. Simple. That's the way the market is working. Then during the whole day time, its market is a little bit calm. but the first 9:30 is very important time. At 4 o'clock, it's very important time. Around that time frame, like 5-10 minutes
After-
around that. Okay. So we can continue now. Okay. I will not go over this one. I will send a presentation as such, but these are some definitions like a delta. Delta is nothing but change in the option price, the option with a $1 change in underlying asset. Then theta is the time decay. Vega is the implied volatility change. Okay, rho is, we can ignore the rho, is the basically interest rate related to thing. But these are called as the first order Greeks. Then there are second order Greeks, which our website is exploding, is the Vana. Vana is the change in delta of option with respect to change in volatility of the option. Gamma is nothing but change in deltas with respect to underlying how much $1 change in the underlying asset. Charm is a time decay. Like if you buy a call, every day you are losing the money, but the person who sell the call is gaining every day the money. Correct? Voma, Veta, Lambda is the another thing I not explored basically. The Voma I was working on it, but not give that much value. And then the third derivative is basically a color and the speed. Now color is not that important, but the speed is important, which is important at the day trading, which is very, very short period of time. The last week is the where the speed is important, which is nothing but how much my gamma is going to change, at what speed. See, stock delta, which says that how the stock is moving. Gamma says that how the delta is moving. And the speed is saying how the gamma is moving. Now, these are not a straight line equations. These are all logarithmic and all those things are there as such. These are not straightforward equations as such. Okay, we'll continue. Now, this is a Black-Scholes model actually. This is basically a Black-Scholes method. This is what I use. Delta is nothing but the change in the delta value divided by the change in the our stock price, and all those things. Gamma is a second derivative, theta. All those things are written here. The another way to write the base, and this formula, like let me give you a few minutes about this formula because these are the three scientists. Okay, Black is the one, Scholes and Merton. There are three scientists are there. Okay, Black died, and then the Scholes and Merton got the Nobel. What used to happen previously is this option is there from the Roman time. It is not something like a new option. Okay, option concept is not new, but find out in this way that what is the value after 10 days of this spec. It's nobody able to tell 100%. How we are going to find out the value after 10 days? We say that this laptop has a value of $100 today, but after 10 days, what is the value? Nobody able to answer with a certainty that this is the way. So they come up with a method. Now, stock moves a Brownian motion. Do you know what is a Brownian motion? First thing I want to make sure. Brownian motion is like, this is the concept we learn in our science. If you put one particle inside the water, you have a tank of water and put the particle. That particle get bombarded with all the directions and it travels any direction. That's happened to the stock. And this Black-Scholes method is nothing but mimicking that Brownian motion. That's all Black-Scholes method is. Okay. Then after this is, I think it comes 1973 or something like that. This is like a very old method. After that, there are other methods also come. This is for the European where the option only expire at the end of the month. We are in America, American expire anytime as such, but most of the time it happened towards the end of the month as such. Okay. So that's the Black-Scholes method in short as such, the three scientists. Black-Scholes method, this is the another way we can write down the Black-Scholes method. And this is the formula. It's like this is exactly the formula which I use in my calculation. That's all, nothing else, nothing less, nothing more. These are the various calculations I done. What is the delta? How the put calculation, how to call gamma, all this. I put all my equations here front of us as such. These are the few things. Another equations. Explain the equation is not. This is not a math class. We are learning to make a money. So I use this type of methods. That's all I want to say. Nothing else. This is important. Always graphs are important. That's the reason if you see my application which I developed, everything is graph because the picture shows 1,000 words. That's the reason we need to learn reading the picture rather than reading the essays and all those things, though no value. Now, standard deviation, it says that the stock is here. What is the probability that stock will here and here is derived by this way. Okay, stock is here, the 2 standard deviation, the 3 standard deviation. Think about one thing here. If you sell the stock here, like sell the call here, okay, or sell the put here, what is your probability of success? Probability of success is all these things. Make sense? Because what is the chance that stock will come down here? Is 13.6 plus 2.1 plus 1 is around 16%. This one. So 100 minus 16 must be this is 84 if you do the calculation. Now 84% of the time, if you sell the put at 1 standard deviation, you are going to be successful. Now if you say that I can do this work very well, if I do a 10 trades, 84% my success. Why not I will do that? Clear? That's the very good strategy. Same thing here. The price goes here. What is the chance that price will be here in this scenario? Is 84%. What is my loss chance? It's 16%. I can do that.
How do you standardize that middle value, 0 value?
Is
So
the
that-
standard deviation, is normal standard deviation graph. There is nothing I'm doing here. It's just the current value of the stock is $100.
That's the current value.
Current value, yeah. Okay, this is not the way actual stock market works. This is like an example where I'm explaining to you as such. Okay, in the current stock market, this graph is like in this way, it comes like that.
Because
Okay.
that will also deviate, right? So according to
No,
your-
no, that I will explain to you, but this is like a think about in this way that if you sell the 16 delta call or 16 delta put, what is your probability? You are making the probability 50% higher. Correct?
But what's the timeline you're talking about?
Any timeline, any timeline. Okay. And that is what we need to understand. First thing, that 1 standard deviation, 2 standard deviation. Okay, how much money I will lose, and I'm not saying every trade you will make it money. But what I'm saying is that probability is on your side. Clear? Okay. Okay, this is very, very important graph. Okay, this is called as a time decay. Okay, theta. When you sell anything, time is on your side, right? You get money to just by selling some crap actually. It's not crap, but you are selling something, so you get money. So how fast? So if you see that this graph is steep in last 30 days, last 60 days it is there, and it is little slowly it is going here. So when you buy anything on the stock market, like a buy call, buy put, you have to do it sometime. I'm not saying no. Buy longer dated options so that time value you will lose less. Agree? Slowly you will lose. Don't buy less than 30 days. Buy. If you want to sell, don't sell it 90 days because making that money is very difficult. If you want to make a money, sell it less than 30 or 60 days. And this is the math actually. I am not coming up with anything. What I said at the start or what I preach my kids, math is the mother of all science. That is exactly I am giving you the strategy. This is the math. How the time decay is going to happen. Use this information for your uses. You can go ahead and sell less than 60 or like 30 days. Time value will be faster for you. The decay, you will make money faster. Otherwise, the risk is there. But when you buy anything, buy longer dated so that time value will not lose you that much money. Okay, very, very important graph, by the way. Now the gamma and gamma versus theta. Okay, now what happened as the time value, like this is a 30 day, this is 150 day. I'm not able to read this, something like that. And but as the time value become less and less, the gamma is increasing. Okay, that is what exactly I'm showing. So when you come near the expiration, the gamma is higher. Then you have to understand whether I should make money by the theta, which is every day by gaining the money, or I should get out of that position because my gamma is getting increased. So this is math at the end. Again, this is the standard thing. This is where the stock market is working. Now, Bhana. Now, gamma is the highest at the money, which is this is the at the money. If you see the previous chart, I was showing the bell curve is at the top here. The Bhana, which is when the implied volatility changes, that happen at the highest 0.2 delta or 0.7 delta. We have to understand that also because when I'm going to show the pictures, remember this 0.2, 0.7. Why I'm saying that? Because that time the delta is high. Bhana effect will be more. Okay. And some of the things, my notes I wrote down there actually as such. Okay. Now, let's go to the third part of that our presentation is that let's go over the application in detail. Okay. So we'll go.
Can you please repeat? I didn't follow why you said 0.2 and 0.7.
Okay. This is the Bhana effect. When the stock is at $100, okay, Bhana will be zero at that time. The how much delta, the volatility change doesn't matter. If that strike price come to 80 or 120, that time the Bhana effect will be highest. It's a mathematically, I'm not coming up with anything here. This is the mathematically says that my delta Bhana effect will going to be or Bhana, every time we cannot see the Bhana. Bhana is important when it is 0.2 and 0.8. This is very important for the market makers. Why market maker? Because they are billions of millions of shares long and short, like option. Their impact is very high. Their stock, the option value will goes down and up based on this Bhana. Okay.
So 0.2 and 0.8.
0.2 and 0.7. That's it. Yeah. That range. Like think about it. Don't just quote for 0.2. It may be 0.2, 0.25, 0.23, 0.25. Those are the numbers overall. Like I'm saying that this area. I'm not saying this point actually. This area is high. This area is high. Think about a little bit common sense, right that way. Okay, so now before going to the continuing the presentation, we'll go ahead and see actual now the demo. But before that, do you want to take a
Yeah.
5 minutes break actually, because we gone over a lot of
Yeah,
thing as such.
but let's come back. It's now 4:25. Come back at 4:30 max.
Okay, sure.
Take a quick.
No, no, no. If you take a break, bio break or anything like that.
He needs a break. Let's stop. Amey needs a break.
Okay, so up till now we talk about the math actually. Okay, and that all the math what we discuss is important for development, but you have to understand that math, why we are doing what we are doing. Okay, it should not be something like all of a sudden, right? So that's the reason I went over the math, all these things. Now we will see in this next half session is how to make money out of it. And I'm going to show my live trading. I am not any means of good trader. Okay, I make a mistakes. Only thing is that how I understand the trading, I'm going to show you will do better than me. Okay, let's go over that.
बिल्कुल बढ़िया क्वेश्चन लगा था नहीं सही चलो कि Black-Scholes method was written for European market, but looks like you adopted it for American market.
Black-Scholes is an American. You can use for the American also. There is a binomial method, which is another method. There are other methods are also there, but at the end of the day, everybody is near to the same thing. Okay, I use Black-Scholes method because I feel that is more important. Now, what is the difference between American and a European? American options can be exercised anytime. Like my current position is a every third Friday, right? I have a lot of positions. Like, let me show you my positions right now. Here is my positions. Where is my? This is
Okay, press kar na.
okay. Okay, yeah. So these are my positions. Where the heck? Okay, it takes time. Like this is the Apple position. So this is what it says that 100. Okay, 17 May 2024, 60 put is what we basically sell. It is going to expire in 12 days. But in American option, tomorrow also that position will get exercised, can be get exercised, no issue. But European, only after 12 days, only on May 17th, which is basically here as an expiry date, on that day only the position is going to expire. But most of the time, 99% of the time, the position get expired at the same time, because who wants to lose that much money? When the position get expired early, if the stock is at like if I buy buy a call, buy a put, sell a put in our Apple, which is basically at $80 and now it is become $20, that will get quickly, they will say exercise the put quickly because they want that money, because that is a big difference now. They don't care about time value now. Okay, but most of the time that is not happen. So whether I use the Black-Scholes method for American or European or anything, for learning purpose, we should think about is happen at the expiry time. Okay, so let's go ahead and talk about this one. Now, this is our website. We can say a stock, the secondDerivativesHub.com. And it is a HTTPS request. Click OK. So what is happened is, this is the first thing. This is a SPX. 10 times smaller is a SPY. This is a NASDAQ 100 shares. This is a QQQ, which is basically a same thing. Next thing, this is not giving me giving trouble a little bit. This is basically a Russell, is a mid cap. This is IWM. is a ETF. These are all our ETF. Now what I'm going, and then there is a something like a Apple, then Microsoft. Let's talk about Apple for one example, or let's say talk about Microsoft. We'll talk about Apple a lot. We'll talk about Microsoft now. Microsoft, as of Friday, that company is 2957 billion, around $3 trillion company. Microsoft is. The price is 404. Gamma flip is 378. Now, to understand a gamma flip, it will take little time. I will get little time afterwards, but this is very important. Understand a gamma flip. And the total GEX is basically a gamma exposure. What is a gamma exposure? So this is positive or negative. And a gamma tilt is the call divided by the put for the gamma is a 1.99. Now, first thing first, let's talk about, let's remove all these graphs actually as such and get one by one graph. This is the call GEX. What is mean by call GEX is current price is a $378. But if you see that the call is the highest at 405. Current price is 404. Yeah. Okay. This is basically a 405 is where the highest GEX is there. Now think about a GEX is the nothing but a wall. The market makers are the positions there. Now, if you run and the wall come, what happens? You will basically little bit stop, right? You cannot just continue running. You will just stop. Like for example, I was giving you yesterday the one example to Nikhil is you are running and the wall come. You will hit one time. Yes, no problem. It will bounce. You hit second time, but third time or fourth time, it will hit the wall and go down. Think about it in this way that these all what I am explaining is a dynamic. Every day this is changing. This is not constant. Okay. But what we have to see that where is the resistance is high resistance and low resistance. Make sense? And we how to use that information, I will explain to you in a few minutes. Then this is basically a put graph. Where is the put highest? Now you can similarly, you can see on the graph that this is the call is little higher than the put, meaning there is a chance that people are leaning towards more on the call side. Okay. This is nothing but a right now the current price actually, which I'm drawing here. And this is a zero gamma. Zero gamma is again, I have to explain how the gamma flip is going to happen on this area. I will explain to that after that. Okay, that's another concept altogether. Like this, when you land on the first page, you are going to see that what is my position. This is at the May 15th. If you see that on the top, what it shows that on the month May, 17th May, which is the third Friday, what are the positions, how the market is laid out right now.
At some point also explain how would you use this while taking a decision.
That is what exactly I'm going to show in few minutes as such. Okay.
Amey,
Huh.
so when you said this is for May 16 or 17.
17.
So this is what exists today.
Today.
Fifth,
Hmm.
For the
17.
of
Tomorrow-
portfolio of everything.
Everything. Now, tomorrow, when I'm going to run the job at 10 o'clock, this may change. Agree? This may change.
This is giving me today's picture of what the world is thinking is going to happen on Monday.
Yes. Don't think about what is the world is happening. Instead of think about it, where is the resistance and where are the resistance? Okay.
What's the resistance point?
Where resistance points actually as such. And we can, how to use that resistance point is what we are going to talk about shortly. And that's the reason I said that we will talk about a real trade. We don't want hypothetical. Okay. We want to talk about a real trade. Okay. And we'll talk about that. Now, yeah.
Blue line and the orange line, they are referring the price of the option. Right?
No, these are the GEX call. GEX means a gamma exposure in the dollar amount. In the dollar. Because see, at the end of the day, how much dollar is involved is important, right? Like for example, SPX is a $4,000 or $5,000 product against the Tesla, which is nothing but $180 product. I cannot just show the gamma actually. It will be misleading. I want to show how much money getting involved, right? That way you will judge that whether this is really important or not. Okay.
Volumes for confidence.
Yeah, exactly. Exactly, right.
Amey, what was the resistance you were talking about? Resistance to what?
Resistance for the stock to move down or move up as such. Or think about those are the walls. Those are the walls where we can say that there is some sort of a resistance to move down or move up. Okay. Yeah. Now,
Amey,
Hmm.
is it just like, why do I feel like a pattern? It's like almost every certain number of points, there's like a big jump. Is it just anything specific? In
No,
between
there is nothing specific. Each graph is independent as such. You can see that Russell position is here. The high position is 2075, but the current price is here, 2055. So that is just the market maker positions right now. That is the right now's reality. Nothing else apart from that. Okay. Now, let's talk about.
Where do you get this data? Like when you say like the ability to import data, is it like?
I have some connections with the brokerage. So I basically get. I have some deal. So I get those deals as such. Yeah.
Then you calculate that data, use for your calculation and predict this one, or is already predicted?
No. This is the math which we talked few minutes back.
So that is the.
That whole math is coming here. Exactly. And using that math, I'm basically showing the data now.
Okay, so similar to you, what you have done, is there anybody who has already done this kind of a thing where you can see that how your calculation?
Yeah.
Going?
Hold these questions. Okay. Hold these questions. Next question, anything? Or we can talk other thing.
So when you estimate indexes, that's on ETF.
Okay, this is what the index, SPX is an index, right?
Sure.
But the SPY is the ETF.
Okay.
Corresponding ETF.
Left
Then,
side versus the-
yeah, NDX is the NASDAQ 100, but QQQ is my
But how
ETF.
to buy index, or is it just data? for
Yeah, you can buy it.
comparison
You can just buy.
Through an ETF.
No, you can buy SPX right now. I can go to the platform. Here is the platform. I don't have to chart actually as such. I can go SPY was there. So I can just say XPX.
So you cannot trade SPX.
Hmm?
You cannot trade SPX.
Yeah, that is okay, but we have options for that. So we can use the options. Here is the options. Here is the options. We can go ahead and buy it, actually sell it. Everything is possible, right? You can go ahead and say that like, I want to. It's a little slow actually at such here, but I can just go ahead and buy the call. That's a simple thing, right? So we are just talking about that only.
Amit, a question.
Hmm.
Can you go to the SPX and SPY, the top one?
Oh,
No,
not here.
no,
Okay,
the other
yeah.
way. Scroll up. Yeah, SPX.
Hmm.
Why is the chart of SPX and SPY different from?
Yeah,
SPX?
there is a possibility that SPX and SPY may not be exactly the same. Not even the ES. ES is the future. SPX is let's say 100. ES is half of that, which is a 50. SPY is a 1/10, which is a $10. And MES, which is another future, is a 5. So those are all have a little bit different values.
So
That
the
is.
difference is big, right? Like why they're not?
They are-
should be copy of each other.
No, that's what I say. This is the market maker position on that stock. Market maker's position.
This is not the market price.
No, the question is
Hmm.
everything
Hmm.
from SPY to whatever the mini future, everything. This is my understanding,
Hmm.
which might be wrong.
Hmm.
Okay, it all depends on the index.
No. Everything get traded. Everything
That-
get traded, and market maker SPY positions where the high gamma, why, like think about in this way. You go ahead and big company buy SPY in a call option, but may not be XPX. So your positions will be little different. Like not your position. I'm talking about market maker. These are all market maker. What I said at the start, who is our friend? Market makers are our friend. All the things what we are tracking here is a market maker, not anybody, bank or industry or 401k or Vanguard, nothing like that. I'm talking about that person, the market makers. Okay.
SPY is an ETF, right? It's
ETF,
managed.
yeah.
It doesn't reflect the index itself. Only in configuration it will, but in terms of value, it is much less.
See, the price may follow the index almost to the T.
Yeah.
But
The GEX position.
The mechanism behind keeping that price is going to be slightly different for each other.
Yeah.
So the way
Hmm.
the index remains at a certain price is because of the value of the actual stocks that
Hmm.
sells in the market.
Yeah.
The way the value of some of these ETFs is going to vary is based on the underlying options that the
Think about it. This is not I'm showing the,
Doing.
this is a price. This red line is a price. But what I'm showing you, these are the positions of market makers. That is a different. I'm not saying the price will be 1/10, 1/5, what I just explained to you. That is different. I'm explaining you what is market makers positions right now in the market. Okay. Now,
It's a rising or 17?
For 17.
17.
yeah, the monthly expiry. Now let's say I put the here, if you just see, I put a Tesla actually, something like that. Okay, and I put a enter here. So what I'm expecting is that what is the Tesla's position? I'm just giving one example. Okay, the Tesla, the last price on 3rd May. Now why I say 3rd May, because my software is only up on the working days, and at 8 o'clock it start, 8:15 it start, and night 7 o'clock it shut down my application. I like whole server gets shut down. So every day 10 o'clock I run my job as such. So if you see that the prices for most of the time we are going to show today will be 3rd May at 10 something, 10 o'clock. Think about it, 10 o'clock. So 10 o'clock the price was $182. Gamma flip is 177. Now, let me explain you gamma flip, because that is important right now. Now, if you see that here on this chart, right-hand side chart, this is called as a gamma or the GEX. If this GEX is a positive, what the market makers are, and by the way, this is what I'm explaining is important, okay? Very important. So what the gamma is positive, at that time, what the market maker does is, when the stock market goes up, or not stock market, when the Tesla goes up, he's going to sell to hedge this position. We come back hedging, that is hedging is coming here. He's going to sell. Think about in this way, when the market is going up, when I say market, meaning Tesla goes up, they are going to sell. When the stock goes down, they are going to buy. Okay, this itself is a 2-hour discussion. Why this happened, but that is a theoretical. We don't want to go into that. You will search a YouTube video for that and you can search it on that as such. It's a very good explanation how that is happened and why this has happened, because it's based on what exactly I shown example I show, which is very small. He goes on the graphs and everything. But when the GEX is negative, important. When the GEX is negative, when this chart is going on the below, I will show you some of the graph for that. At that time, what is going to happen? When the stock falls, market maker is start selling the stock. And when the stock goes up, they are going to start buying the stock. Meaning what? Positive GEX, they are reducing the implied volatility. They are restricting the movement, because when you go up, they're going to sell. What happened? It goes up, it starts selling, it will come down. It goes down, it will start buying. So implied volatility is reduced. When the GEX is negative, what happened? It basically, it's when market is going down, when the Tesla is going down, they will sell. Meaning it goes down, 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 down. If they goes up, they will start buying. So they are increasing the implied volatility. This is very, very important in our trading. Okay. Next thing.
Can you bring up a
Now-
junk stock?
Huh?
Can you bring up a junk stock like Rivian or something?
Rivian, I will show you. Yeah, I will show you that. Okay, let me just finish this and I will get that as such. Okay, yeah, I will do that. Now the next thing I want to explain to you is this one. The gamma clip is what I want to explain. Now this right now is a positive gamma. The way I calculated is what is the price? The current price is 182 at this time. That time the gamma clip was 177, meaning if this price goes below 177, this positive gamma going to be negative gamma. That change is a drastic, because that movement, what the stock market, the market maker is going to do is that initially they are suppressing the move, they are assisting the move now. That itself is a one trading point. Clear? Everything is mathematical, nothing else. What I'm going to say is something like this is my thought process, nothing. Math says that is what they are going to do. Now let's talk about this chart. This is an important chart. Ignore the 3rd May because my data was 1 day old, or Friday's data. So that's the Friday date is there. So on Friday, think about it, Friday you are looking at this chart actually, think about that way. So on Friday, BT is a 0 days to expire. Option OI, which is option open interest. P for put wall was 180. Gamma wall was 180. May not be the same every time, by the way. Okay. Why this wall is important? Because open interest is how many contracts are open at that strike. But gamma wall says that what strike is the highest dollar amount get associated, because strike is not only the open interest but associated with a delta also. Now, if this trap is at 120 open interest, may not be the gamma is high, that it is not going to impact us. So gamma is important, and that's the reason it is a dark color. If you see that this is a light color, this is a dark bold color, because this is important. We'll come back to the max price shortly. This is not that important as the viewer point of view. What it says that put open interest was 481K, call open interest was 510K. But what is important is this value and this value, like this value in this case, open interest. Then the gamma wall is 180. Now, if you see that on Friday, Tesla supposed to be close at 180. Are you agree with me? Correct? Let's go ahead and take a look today. What is the price actually? Because I not checked Saturday, Sunday, what is the price? But it should be supposed to be 180 actually. This data get created on the May 3rd at 10 o'clock. There will be some impact during the day. But what I'm expecting is that 180-ish should be the Tesla price. Okay. By looking at this data, I'm just saying. So let's go to the now Thinkorswim platform. And let's search for the Tesla. And what we expect, it should be around 180. That is what I am just saying. So let's see, where is the price? It is 181. Now, do you think that it is just a coincidence? Somebody will say that they can bluff actually, saying that, hey, no, this is just a coincidence for you actually. Like this, we can show a multiple symbols and show you why the prices stay there. I'm talking about how many. This is a 500 to 600 billion dollar company, and we are pinpointing where the stock is going to stop. Do you see there is a value? Just think about like that actually, that we can pinpoint where the value of the stock on that day.
If you
Okay?
go back, it says there is another day, right?
Hmm.
So if you go back and see, maybe future in future, the dates, on that day, the price will be that. It's a rough estimate, right?
Like I was just showing you that that is the price I'm going. I said, we generally go by the future, not even back actually, because going back is not a value, but I have some, we'll figure out some of the present in this, but think about that. Okay, there is something which we can see here. Okay, so
The
now
main columns to look for
is
is
the bold letter,
the walls.
bold letter,
The
the
bold one.
180, 180. Now, these are basically these are how much dollar is going to expire on this Friday. Because this is a Friday, right? 3rd May. $22 billion, this is in millions. $22 billion are going to expire. Now, as 22 billions are expire on Friday, Monday when I'm going to run it, I will have a different picture altogether, right?
What do you mean
Because
by expire?
Expire. Now options are get expire. How many open interest rates there here? All are going to expire. Somebody will get money, somebody will lose the money,
Yeah.
but their values are zero as of now. So Monday it will have an impact. Clear? So that's then gamma tilt. Gamma tilt is nothing but call gamma divided by the put gamma. As such, the normal value is a useless. What we need is the extremes. Like if this value is 3, 4, something like that, is reversal is due. Too much high, reversal is due. Too much low, 0.5, reversal is up. Do you see this? Actual value of 1.88 don't have any value.
What's the average then? Like,
That is where I'm saying, like below 0.5, up 3, 3.5. It changes by every stock by stock. It's like a SPY will have some other gamma. That is nothing but learning the application and how you how you trade, how you look at the data, that you develop your application. Like I do the calculation here, but the trader who is going to use this application, he will see, okay, last time it was for Tesla, it was around 2.3 and reversal happened. Okay. Now this is happening. Now this happened. That is basically a knowledge building. Okay. So slowly the people will understand. And okay, the gamma tilt. Is this, I develop it, I've done the calculation, but the information is there on the Google. You can just go and search it. You can read the information. It's everything is there in the internet. It is nothing proprietary here. Okay. Now,
I make question.
good.
How is this gamma tilt different from simple call to put ratio?
Okay. Call to put ratio is useless. Literally useless. I done the 3 years back the analysis on that. There is a lot of videos also on that. It's not helping me out. Then delta of those call and put also I done. Put call ratio it's called, not call and put. Put call ratio is also useless. And that's the reason I use the gamma. It has a value. And you can see that how that value is there actually as such. But just search on this word debunk put call ratio. You will see a lot of things actually as such. Okay. And another thing is that at the end of the day, your experience is most important. You wrote down that you find out what is happening. Your thought process, this is happened today. This is history going to repeat. The stock market is not changing day by day. Okay. But you will use that previous history, which when you start trading, you start understanding, okay, this is happening, this is happening, this is happened, this is happened, this is going to happen. So you will find out that knowledge. These are basically what I'm giving you the key points, how to use this data. Okay, next thing is a 10 May. 10 May, this is the value. Now 200 is the call wall. Now we can see on Monday. Now this is again the dark line. This is a monthly. I generally go by a monthly because the absolute GEX is the highest. Now this is the GEX highest because last week the conference call was there for Tesla. If you notice that The conference, that's the reason that is 100. But otherwise, normal scenario, you will see that these values are lower and this value is higher. We can see another. Let's go to the Microsoft in few minutes. But that is you will see that actually as such, or gold or anything like that. Okay. Now, what I did is basically this is the picture, and also another thing. What I am writing down here is not predicting anything FOMC meeting or the conference call. This software not going to identify that up and down. Like for example, Apple, their shit, they're not able to sell it. Their revenue is less. But what they said, they're going to buy back $1.1 billion stock. Stock jump up. Because all of a sudden, the 1.1 billion stock you are getting out of the market, the current stock goes up. That this software will cannot address, because once that is happen, after that market maker make their positions, and then this software will show. But that this software is not capable of understanding the future for that type of. We have to understand what context we are talking about, and we have to realistically. We cannot just say that is going to happen as such. Okay. Now I will go to and we'll use the Tesla's example in the few minutes to how to use this for trading. But before that, we will talk about this little bit on the graph actually as such. But at the end of the day, what our task, what we said, how to make money out of this. That is, we should not forget about that. So we'll come back on that. So this one, it shows us how the GEX is there, how the GEX is, this is the zero line, how the GEX is flowing around. What is, I talk about gamma flip actually as such, when it positive to negative, negative to positive, and what exactly market makers is going to position themselves, whether they are assisting the move or they are suppressing the move, which is nothing but implied volatility is going to increase or going to decrease. Okay.
So right now, this is showing that June 21st, or right around then, it's going to below zero.
Okay. Now, one more thing I will explain to you, another thing.
So what does that mean?
Yeah. As of now, that position is a negative. If you see that absolute gamma is negative. But as we go, this software is really good for predicting next 30 days to 60 days. Don't use this information for a long period of time, because tomorrow's impact is going to happen on that June. Day after today's impact is going to happen on June. So what is important on this is little bit near term. Okay, my near term is nothing but 60 days or less, 45 days, 30 days. And that's the reason I generally do trading on the monthly basis.
Does that include the quarterly result impact that maybe like a Tesla, you see that it was significant from?
Yeah, that is what exactly I told you a few minutes back. Conference call, the quarterly impact. They may not know till they come the news and other people like investors and all those things, how they position themselves, and then the market maker, how they position them, then it will show. But before it happens, it cannot expect. It cannot say that the like Apple, its share is I think 120 will go to the 178 or 138. That is cannot explain.
But before they announce results, like oftentimes the day or two before, there'll be a lot of market volatility.
Yes,
Is that factor?
that factor is here. But the moment the conference call is going to happen, after that, what happened? They will not know that actually, because how you know the software, like a market maker will know that the Apple is going to buy back 1.1 billion, like 1.1 billion worth of shares. They may not know that, right? That's the reason they cannot position themselves. Okay, this is my understanding. There may be internal understanding with investors and something like that. If that is there, then it is already, they position themselves, market maker position themselves, that is already captured here.
They also get the insider input.
Exactly, the insider input and all those things, the investor got it. They position themselves. Okay, market maker position themselves, that information is here. But the unknown informations will not be, like, think about it. Tesla, Apple shares supposed to be fall down actually. 170 was it's a gigs that time actually. It's supposed to fall down on 170. It goes up. Yeah. And it went to 187. Why? 187? Short selling. Lot of people are getting stuck. Tesla, the same thing happened. Lot of short people are burned, I think $6.3 billion or something like that happened for Tesla. It's a huge amount of people who are short selling because they are expected the market will go down. Like Tesla will go down.
It was a down actually, but
Yeah.
the moment he tweet and then everything got changed.
Yeah.
immediately.
Yeah. That's it. Then
China announcement saved it.
yeah. So that is what exactly I was saying that all this information before the market come like a FOMC meeting, like right away today or like in FOMC last week FOMC meeting, they reduced the 50 basis point. What happened? Market will tank up. Boom. That information they will this software will not know actually because what FOMC is going to do.
Yeah.
But once they done that, once the market maker position themselves, then the data will get populated here automatically. And then again, the balancing will start. So this is for the normal scenario, not for exceptional. Okay. So we'll talk a lot on
Quick
this.
question on this, is this an aggregation of all the contracts that expire on that day or where does the strike price come into play in this?
Yeah.
Because what I'm
So
wondering.
this one is the aggregation of all the open interest for the 3rd May
For what?
for Tesla,
For
All options or just 180?
all options expiring on May 3rd,
and regardless of the strike price or?
regardless of the strike price. Problem is that if I put a strike price like this graph will be like a million lines long actually, and then if I give too much information is useless,
But
right?
I thought, so see this, here's my confusion because when it gets close to the expiration, right? Normally, with what's in the money, right? That's what's, it basically revolves around what's in the money, right? Around that time.
What?
If you are basically looking like maybe 2 or 3 weeks away from today,
I'm saying that here,
then the open interest in something that's way away from the money.
it's here.
Will be very different.
Yeah, it's here. You can see that on 17th May, open interest is 486K.
But I see what I'm not able to understand, if we aggregate based on everything, regardless of the strike price, then I'm not able to get that because how do we?
Okay, I will show you here. This is a Tesla actually. Okay. Let's get to the Tesla actually. Now I cannot show 3rd actually. 3rd is expired. So I'm going to show the month of May. 10th May. You can see that there is a implied volatility open interest. These are all I'm talking about. 9503, 2354, 3602, 28. All these things added actually as such.
And
Now,
that's what I'm struggling.
I'm showing to you now. Next thing. Let's go to the 17th May. You have a different open interest.
Yeah, obviously that will be different, but what I'm saying is that as you deviate away from the money
Hmm.
strike price, right?
Hmm.
The open interest, the meaning of the open interest kind of fades away.
No,
because now.
open interest. What is the definition of open interest? Is nothing but that many contracts are open at this moment. That is nothing to do with in the money, out of the money. Open interest is just says that. See, I will give you an example. He buy a call. I sold a call. 1 open interest. Volume is 2. 1 open interest. You buy a call from me. Open interest is not interest because that same contract goes to you. So that when we do the trading, you say that open or closing. I will show you here. Like this is my put, right? If I try to close this, what it says, it's not showing here, but it shows when it places the order, it's going to show 2 clothes. 2 clothes. Okay. Now, what maybe my working orders may be there here. Let me see. Should be there something. Okay. Do you see that 2 clothes? Position effect, 2 clothes, 2 open. So this is basically called open interest. I'm increasing the open interest or closing the open interest. It is nothing to do in the money or out of the money or at the money. Make sense? And here what we are showing is, we are showing for the method how many put open interest was there and call open interest. But to be frank with you, ignore these values for that. Try to understand what is important, which I mark it in a blue color, like a dark color. Because if you go ahead with the useless information, then we will be.
Derivatives are not taking into account the open interest. Because what I'm trying to say, so let's say there is open interest to buy Tesla for $5, right? And you can buy it for like 1 cent, right? That contract. You can buy it for 1 cent because it's not gonna happen, right? So are you factoring that into your wants?
Perfect. That comes on this wall. Open interest at 180 is the maximum. I'm not looking at that value, but I'm not even looking at open interest at 180. I'm looking at the gamma value. Where is my gamma, which is the more important?
And that gamma doesn't.
Gamma has the delta, and delta has the value. What you're talking about is the 5 cent has a delta maybe 0.01.
Right.
Okay, I calculate that, but the effect will be very less.
Right.
It will not come to the picture as such. Okay, so now I want to show these two graphs. Below these two graphs is what I want to show. Okay, so ignore other graphs. Now this graph at the start when it comes is the current week. Always it is a 5-3, and we are looking at the Friday actually today. The 5-3. But this graph is always at the monthly actually by default, because that's the way I look at the data. I develop the application for myself, right? So I look at the monthly data. So I say that this is a monthly. But when I say monthly, I not say this monthly actually, which is this is a monthly right here on the top. I'm not talking about that monthly, because that monthly is individual. When I calculate this is a summative of all the 3 weeks. Because see, as a market maker, I have to manage my delta at the end of the day. My position, my today's position, next week position, after month end of month positions are impacting, right? To hedge I'm hedging my whole portfolio. And because of that, when I draw the picture there, it is basically a summary graph. But if then you can say that why we are putting a weekly and then the monthly, because some people do a weekly trading. So for them, this graph is more important as such. They don't care about that graph. They generally go into this one. Now, if I want to trade for the next week, May 10th, what is going to happen is here. I just go here, come here, and May 10th. Here you can see that in order, it is all the expiries are here. If I just search it here, it's basically, now you can see that graph is changed. Abhijit, do you see that the graph is changed? Because the position of the market maker is different now. And that 3rd May and 10th May summary is here on this graph. Third one, if I go ahead and May 17th, this is May 17th expiry, but this is a summary. All the 3 weeks still expiry. Actually, I don't want to go further down actually as such. Like you can do this here. You can go to the next month, week, and all those things as such. Okay. Now, next one is here, Vanna. Now, this is very important actually. See this. On this is first thing is that this is a chart. Now, what I said, the chart is basically the time expiry. Okay. Now, how that chart is getting impacted is what I am doing a study also right now. Okay, I don't have the exact answer how much it is impacting. Second thing is the Vanna. Vanna, the strike price is here. Generally, where the Vanna is more important is basically 0.2. It is there here. It is not showing here as such. I wrote down here on the decimal points where it is impacting. I wrote down that it is not showing here. but that is what exactly I show for the Vanna graph as such. Okay, but we have to understand Vanna is important when it is at the high at around 0.2 to 0.7 side, 0.2 and 0.7. Now, more important on that one actually is Vanna is a magnet or the repellent. Okay, that is okay. Before I explain this, let me explain you the cycle first. That way, you otherwise I feel like you're losing the context actually. Okay. Think about it every month. The month is getting started. Okay, every third quarter, every third week, Friday, the option expire happen. After that, the stocks are little bit free fall. They don't have impact of the trade like gamma, Vanna, charm because they're all the expiries happen. Let's say on the 17th of April, 17th of May, the options are expired. The current May option. After the Monday, the stock is little bit free fall. Market makers start putting their positions. Okay. Initially, little bit gamma is impacting, but gamma, Vanna, and everything get impacted in last 2 weeks. Okay, not every time everything is impacting. Last 2 weeks, like today is the April, the 17th May. Now this week and the next week, the gamma and Vanna will get impacted, and then you will see how the market makers are positioned. No, market makers are not opposing to you actually or anybody. They are just making their positions. They are making their own money actually. Lot of time people say that market makers are crooked. They are taking my money out. No, they are just putting their positions. And what we are doing is that looking at their positions and understand what we should do as a trader as such. Okay, so it's not like every week we have to see from the start to end. No, there is a cycle. And why I say monthly cycle? Because on monthly, typically the gamma or the GEX expire more as such. Okay, apart from the volatility because of conference call or something like that. Now, this graph, below graph, it shows us the premium distribution. Like what you are asking me, this one is how much dollar amount is getting impacted. Like you buy a $5, that comes here. And I not show each and every strike. If you see that the stock is at 185 right now, I show some strike. If you buy maybe 100, I even don't care. Who cares about the person who buy 100? Because the probability of that is going to happen is none. So ignore that. Huh.
Does the third Friday concept affect ETFs will expire also?
Yeah, ETF not expired. Only the options are expired.
No. So whatever affects a company like Tesla because it's a single stock, and their price changes because of the earnings. Does that concept also apply to the
ETF, everywhere, market, everything get impacted. Because remember, derivative market is way bigger. What I said at the start, equity market is a $50 trillion market. But derivative market maybe 10 times, 50 times, we don't know. It's a very big. Okay, if you just go at home today and say that what is the SPY price today and how many shares are there and see the contract, one contract belongs to 100 shares. Do the calculation by yourself. You will see that it's a huge, and we don't know how that even work out everything. At the end, the stock exchange is responsible to assign their shares. They do that, whatever their open positions, closed positions, all these things. But derivative market is the more important than the actual equity market. And that's the reason what I said, gamma, Vanna, charm, everything get impacted in last 2 weeks of that expiry. Okay, so this shows us the premium distribution, and you are asking me about every strike. So I put every strike here as such, and then here is the speed. I will say ignore the speed right now because the third derivative of the gamma, which is like it's a gamma derivative, So we can ignore that. Then I was thinking something in my head that what is my position yesterday? One day before Gates position. You saw the Gates position today, right? What was yesterday? I want to see it. And day before yesterday, what was my position? Why I need this information is what I'm doing a trading, is it really a makes sense? Yesterday, this was a position. Today, so day before yesterday, this was the position. Today, this was a position. Yesterday, this was the position. Today is this position.
So what is it telling you?
Yeah, that is basically, you can see that here, lot of call is happening 2 days before.
More money is being.
More money on the call side is getting bid. But here you can see that slowly, put side is getting increased. Do you see that? Like you will understand. Now the people 2 days back, lot of people are betting on the Tesla to go up. They come to reality yesterday saying that it is the puts are getting sold. Now they are protecting their positions. And today what is happening is this is happening. Okay. If today is this happening, how I should trade? Okay, how to trade, I will show to you actually as such. But do you see there is some pattern is getting developed so that we can see where is and how the peoples are their position. People means market makers are position themselves. Okay. Now,
based on this 3-day history, how would you go about trading?
Yeah, I that is exactly I'm going to show the next point now actually.
What kind of
Yeah,
strategy you
yeah.
follow?
And I'm going to show the exact same point now to you. Okay, so let's address the Ashwin's question now. Now let's go to the one of the chart actually. There are a lot of tabs. I show you on the tab at the start. And let's continue with the Tesla. Now Tesla on May 17th, you can see I'm talking about this line particularly. This is the line I'm talking about. What it says, the put price is 180 and call strike is 180. I know this is only the information that around 180, that stock had some resistance. I come here.
That's the one you're talking.
Yeah. I come here. I basically take a look. Okay, is a positive gamma is there. I can see this graph. I can say that this is 180 and this is basically maybe 185. So this is 180 is there, but there is 185 is also there, right? So what I can think as a trader, what I will think is that how can I use this information? Okay, let's talk about that. What I said, it has a resistance on 180 and it has a resistance on 185. My other application shows 180, but when I go and take a look the cumulative graph of Tesla for the monthly, what it says, it shows 180 is the highest point. I agree, but I want to use 185 because I'm a little bit safer side, right? How I will use this information? I will go ahead to the May month or the Tesla. Let's go to the Tesla. Okay, for the May. Okay. Now, what we know, it had some resistance on 180. So what I said, we can go ahead and see this option open interest and see that 146,000 open interest is there, meaning some sort of resistance is going to happen. We can start selling this. Let's say go ahead and sell this. I will just going to show different things actually. Okay, I'm not going to show only one, but let's say I sell this and basically I call side 185 is where the resistance. I come down because I don't care about what this software says. I come again little bit ahead on the open interest. I see the maybe 14,000. So I basically sell here.